Hello and welcome to the world of finance with Dr. Zahoor. Today we will talk about various financial instruments issued by corporations. We have financial instruments, share, preference share, and debenture and bonds type. Let us discuss briefly about them. Company, we know that it is an association of persons combined together to do some business. And the motive of doing business is to earn the profit. So profitability is the main motive. Every person in the world, they have capital and they want to employ that capital to earn the money. Similarly, there are certain opportunities which is not in the hands of an individual or few individuals as partners that they can combine and do that kind of business. So company, we have innumerable number of persons combined together, so they will do business. So once a company is registered, it is registered with authorized capital. Here I will talk about, we have different kinds of share capital. Let us understand what they are. First one is authorized share capital. Authorized share capital is a maximum amount of capital which a company can raise from the market. So memorandum of association will be having a clause where this capital will be given, that this is the capital which a company can raise from the market. This can be altered by certain legal formalities later on, but the thing is right now we will take this is the authorized capital. Example, 100 crores is the capital which a company can raise from the market. Second part of this is issued capital. Issued capital is that part of the authorized capital which has been offered to the investors for subscription. So if 100 crore is the authorized capital, let us say in the first stage, company wants to raise 20 crore money from the market. So this is the issued capital. Third is subscribed capital. This is the part of the issued capital which public has subscribed. That means they have conveyed to the company that we are ready to give this much of money to you. Out of the recent example, if we have offered the general public that to subscribe 20 crore capital, they may subscribe completely for this 20 crore. They may oversubscribe, but the thing is company will issue only for 20 crores. Similarly, they may subscribe for a less portion, like 15 crores. So that is the subscribed capital. Finally, the term paid up capital. Paid up capital is the amount of capital which actually investors have paid to the company. So this is the money which actually company has received. So these were few types of share capital. Now we will understand what is share, what's its meaning, and what are different types of share. Share is a certificate of ownership in a company. In simple terminology, we are understanding that we are having a cake in front of us and we want to distribute it among 5 persons. What will be my share? Similarly, company is a large structure and it needs a big amount of money. So how much portion I will purchase from that company, that's my share. So in simple words, we can say share is a certificate of ownership in a company. Now point is here, my control in a company, how many shares, how much proportion of share capital I own, that depends. Example, if we take an example of a Reliance company, there are lakhs of shareholders. But why we know only about Mukesh Ambani? Because he is holding the majority of the shareholders, majority of the shareholding in a company. That is more than 51%. So this was share. Now we have two kinds of shares, preference share and equity share. First we will understand briefly what is preference share. The word preference share means preference shareholders will be having preference over equity shareholders. First, to receive the dividend out of profits. Second, repayment of capital. Whenever company distributes dividend to the shareholders, it is the preference shareholders first they have to receive, they will be paid the dividend. It is written in the preference shares. Second, if company is closed in any case, whether voluntary or whether compulsory wind up, so it is the preference shareholders, they will receive their money back. After, if anything is left, that will be distributed to equity shareholders. We have some kinds of preference shares, like we have cumulative preference shares, we have participating preference shares, we have convertible preference shares. There is a minor difference between them. Like cumulative preference shares, dividends get accumulated if it is not paid in any year. For non-cumulative, this is not the case. If we have a profits, we will distribute the dividends. If we don't have, we will not pay in the subsequent years for non-cumulative preference shares. Second is convertible preference shares, non-convertible preference shares. The difference is that these shareholders, convertible shareholders, they will be given right. They will be given option that they can convert these shares into equity shares after some expiry period of time and with some stipulated conditions. And non-convertible shares, that we don't have that kind of condition. Number third category is participating and non-participating preference shares. So that means once a dividend is distributed to the preference shareholders, later on dividends will be distributed to the equity shareholders at certain rate, and whatever is left, participating preference shareholders will participate in those profits. So they will get additional profits, and non-participating preference shareholders, they will not get that kind of things. Next category is redeemable and irredeemable preference shares. Redeemable preference shares, they will be having condition that your money will be repaid back after some expiry period of time, like after 10 years, after 20 years or 30 years, it will be given there. For non-redeemable preference shares, this condition does not apply. The money given by these kinds of shareholders, that will be held by the company for an indefinite period of time. Next, we will learn about what is equity share. Equity share, this is the powerful tool in the stock market. It is having potential to double, triple, multiple times your money can grow. But at the same time, these are the shareholders who bear the maximum risk. They can lose the money. So equity shareholders, also called ordinary shareholders, they are the real owners of the company. They receive maximum money in the form of profits. They receive maximum money in the form of capital appreciation. In addition to that, they have voting rights. They exert their voting rights in the management of in appointing the management. We have two kinds of shares here for the preference, these equity shareholders. The two terms I want to mention here: bonus shares and right issue. Bonus shares are the shares which are issued to the existing shareholders without receiving any payment. So we give shares to these existing shareholders without any charge. So we distribute the shares to them, but we don't receive any payments from them. So why we do that? We capitalize our reserves. We issue new shares in lieu of capitalizing those reserves. Next is right shares. If a company at any stage wants more money for expansion, for modernization or any other activity, or doing some other diversified business, so what they will do is they will decide we need more money. So what they can do is either they can issue to the general public or they can issue to the existing shareholders on the basis of their rights. So that's called right shares. So shares will be issued to the existing shareholders on the basis of their rights. Right can be like I am holding 10% of the shares. The new shares I will receive 10% out of the new shares. Next we will understand debt instrument. Debt instrument is nothing, it's like a giving loan to the company. Company is issuing small certificates. That certificate is simply a company acknowledging that I owe you money. In this certificate will be written there. In addition to that, there will be written what kind of rate of interest I will pay you and when I will pay you money back. These are the conditions there. Two terms named here, bond and debenture. These terms are used synonymously. But the thing is, bonds are used particularly when government is issuing these kinds of securities, and debentures are used when corporations are issuing these kinds of securities. So this was about various financial instruments. One of these instruments are issued for the first time. That's called primary market. If I as an investor has purchased that thing, I cannot go company back that I am having equity share, pay me money back. So no, that's not possible. Company won't pay. Now, if I need my money back, where I can sell these securities, I can go to the secondary market and I can sell it there. There will be some other investor who can trade with me. Now, in the next lecture, we will understand the ecosystem of stock market. From the time investor is buying the securities till the time that his demat account will be credited with those securities. So what are the various institutions involved? We will understand in the next lecture. Thank you.